Started a limited company and wondering how to account for the money you've put in? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And one of the key questions we get asked early on is, okay, I've put some money in, how do I deal with it in my books? Or how does it work for tax? And in this video, particularly around limited companies for this one, I just want to talk about the main types of how you would deal with the money going in, what they could be, and how that looks for tax. And then right at the end of the video, I want to talk a little bit about practically what to do in your bookkeeping records to account for that. So before we get into it, if you click on the subscribe button below, you get notified whenever we release a video just like this one. So I think the best place to start is talking about the main thing when you start a limited company is you have something called share capital. Now don't worry about the term. What it really means is you as the owner. When you start a limited company, you have to put, who's the director, who's the person kind of in charge of it, and who are the owners, who's the person that owns the shares, the shareholders. So most of the time in a small owner-managed business, that's you, the shareholder. And when you form a company, you have to give the company some money for those shares, and normally that money is called share capital. Now quite often when you form a company, you might just have one share at £1. I quite like 100 shares because I think later on and you can divvy it up in different ways, and it's just a nice number, isn't it? But normally the kind of standard thing would be that those shares would be worth £1. So you quite often start off with 100 shares at £1. So the first £100 that you put into that company should be your money for your shares, your share capital. So quite often you're going to put something in the bank account from day one to fund it and then buy your expenditure out of. Sometimes you might have started the company beforehand and have a little bit of expenditure that you need to be repaid for and things, but in an ideal world you'd have formed that company, you'd have got that bank account, and you're going to introduce money into it to then go out and buy things. But that first £100 you introduce into it, in this example using the 100 shares, or would be your share capital, or if you done £1, the first £1 you put in would be your share capital. So that's there. Now you could introduce more. You could issue yourself, and I saw it the other day, I was geeking away looking at a local restaurant that had started up and wondering what their balance sheet looked like after their first year, and you can see these kind of things on Companies House, and I noticed actually they put 40 grand in at the beginning and they put it in as share capital. Now there could be reasons to do it, but realistically a lot of the time it's not a great tax result. You put this 40 grand in, it's kind of locked in those shares until a later date. Now there are reasons that might be, especially in high growth companies and bigger companies, there are reasons why you might want to do that, but for a lot of small businesses that's not normally the best ideal thing to do. And the reason that is it's tied up there really until if you want it back, until you close it down. And you can bring it back out with things like paying yourself the profits in dividends or paying yourself salary, so it doesn't stop the cash coming back out. But what it does do is it stops it being really tax efficient. And we'll talk about director's loans in a minute, and it's far more efficient a lot of the time to put it in as a director's loan. So, but that is that money. So you could say that those shares are worth £400 a piece, and then you're putting a load of money in. So you've got that ability to put it in as this share capital, but it does just think it kind of locks it up until later. So I mentioned director's loans, so let's talk about those. Now they're probably the most common way of putting money in as a limited company when you start up, and it sort of opens your account. If you imagine going into a bank and opening a bank account, you've opened your account with the limited company by saying, okay, I'm going to put £1,000 in to begin with, here's £100 for my shares, and the other £900 is going to be my director's loan account. Now if you imagine the company, because you and the company are separate things, now owes you £900. So on its balance sheet, which is kind of the document that says here's everything that the company owns and here's everything the company owes, you're going to have a liability and owing from the company to you for that £900. So later on, when you go to take money from the company, the first £900 that you take back could easily be the repayment of that money. So, and in your records, we'll talk about it later, how you enter it, but you'd have this £900 sitting there to be repaid to you at a later date. So if you literally drew it back out of the bank, there is no tax consequence because you've put it in. So that money it would have come from your taxed income from somewhere else. You put it in, it's already been taxed. So when you take it back out of the company, there's no issues with that same amount. Now, where people lose out, and it's a bit of a tax trap I want to mention here, is sometimes they'll just use that loan to pay themselves. So if you think about it, if you put 10 grand in, the first 10 grand, you think, oh, it's great, I'm going to bring it out tax-free. But they might not take into account that actually they've got other allowances that they could use before using that 10 grand. So let's say you had cash in there to repay that 10 grand. You might look at, okay, actually, I could pay myself a dividend at the time of recording this video. You get £2,000 a year tax-free in dividend. You could pay yourself some salary potentially. If you've got no other income, you get about 12.5 grand a year at the time of recording that says you can have tax-free, and that would also reduce your tax bill. So there's lots of other things you could do before touching that director's loan, and it's an amazing thing to have from the start. So if you're going to do it, generally that tends to be the way, is to open up this director's loan account. The next one along the line tends to be very similar, and that is a family loan. So normally the bank of mum and dad, or nan and gran, or whoever have lent you some money to start this business, and And often you would show that again in the balance sheet, and it depends how you want to identify it. If it's a personal loan to you and then you've lent the business, you might just open up a director's loan. A lot of people like to show the actual direct loan to the other person on the balance sheet. So they'll open it up in literally a loan account to, mum loan, and it'll be there and it's due back to them at a later date. So similar idea, it's come in taxed, so it's going to go out tax free. So the same similar type rules apply. There's a few caveats, but generally it's the same sort of treatment. So family loans, very straightforward in that sense. And then where it starts to get more complicated is there are these things called startup loans. So if you've been looking for all the funding that you can potentially do, I think a lot of people think, I'm going to go start a business, someone's going to lend me the money. Now, actually, that's not as easy as you think it is. A lot of the time, if you go to a commercial bank, at the minute, it's obviously a bit of a nightmare because of the COVID lockdown as we're recording these videos. It's very difficult, but in better years, you'd go to the bank and they might say to you, yeah, great, give me 50% of the money and we'll give you 50% of the money or something like that. But what there was the option to go to some, and a lot of the time they're government funded bodies, but they would put you through a startup loan process. So you'd submit a business plan and then you could get a loan. Now, a lot of people see that as startup funding. All it really is a personal loan at a relatively cheap interest rate, arguable these days, but for example, it might be backed by Virgin Money or someone like that, and they would give you a personal loan. I saw a new client recently, 15 grand, had gone through the process with a business plan. They've got 15 grand to go and do. Now, they are a loan, so they're repayable. Now, the issue is with a limited company is normally they're in the director's name. So if you imagine you've got 15 grand that's gone into your personal bank account and you're repaying them back every month. Now, there are some complexities around this, which probably is too deep to go into in the video, but all I would say is just remember that they're separate. So if you put the 15 grand into the limited company, what tends to happen is you open up a director's loan account for 15 grand, which is great because then when you take the 15 grand back, it's not going to be taxed. That 15 grand to you is not going to be taxed personally to you. However, because you've got repayments coming out over 5 or 6 years, if you imagine if you suddenly earned enough in the company after tax to have 15,000 to pay yourself back for that director's loan in the first year, and the loan was say for 5 years, over the next 4 years, you're going to have to deal with those repayments because the repayments, you might want to start drawing more money from the business to pay down the repayments that are coming out your personal account. And then you've got to deal with the usual thing of that's like paying yourself. So is it dividend? Is it salary? And those things could have tax associated with it. It's a difficult thing to explain, but it's trying to get that idea that it is a business loan, but it's really for you and it's not the company's money. And if you're going to give it to the company, great, but you've got to deal with the repayments later if you need the company to fund those repayments. Hopefully I've explained that well enough. If not, drop it in the comments and we can have a further discussion, but it's getting your head around those two things. So that's kind of startup loans. And then the other two things I've got to mention, because in the world we live in right now, they tend to be the holy grail everybody looks up to, and that's kind of like venture capital money and startup capital from other institutions and angel investors, that kind of stuff. There are people with money that want to invest in businesses. Everybody wants to be the next Amazon or Google or Facebook. So there are that money around. You'll quite often hear terms like EIS and things being bandied around, and they're all to do with the company getting a certain type of approval so that people who are buying shares in that company, in your company, so you might give away some of the ownership effectively, can get really good tax breaks, and it incentivizes them to lend you the money. Now, there's a massive world for that. There's lots of different sites and ways of getting you that kind of money, but they are there. What you generally need, of course, is to show a good business plan or some good trading history. There's quite a few hoops to jump through to get this EIS that a lot of people would want you to have. So there is that option. You have got this kind of angel investor money, but it gets more complicated. And of course, you're giving away ownership. That might not be something you want to do. So that's there. Now, the other thing is crowdfunding. Now, really, what's that? I'm thinking 2013, 14 was really where we started, I suppose, to see the biggest growth in that from our own experience. And you have sites like Kickstarter and these other places where you could, list your product well in advance. And there are a lot of companies that fund primarily their initial capital. They've got an idea and they go on Kickstarter and people pledge this money to them. Now, that is outside the scope of this video and because there's too many things to talk about. But if you imagine generally, if you're going to go and put a product up there, quite often it'll be counted as income, like any other business income. It's kind of like advanced sales in a way. And I'll caveat that because it really depends on how you're listing it and what you're doing with your rewards. VAT is an entirely another discussion over this. But if you just think a lot of the time, you're just getting advance money for your product is probably the easiest way to think about it. But that is one way to do it. If you're going to do it and you're going to generate a lot of money, I think it's worth talking to an accountant about the VAT potentials. I know if you look on, say, Kickstarter's site, there's some FAQs that they've done for the US around VAT and tax treatment to give you a bit of a feel for it, but realistically it's definitely worth getting some specific advice if you think it's going to be a relative amount of money. But yeah, crowdfunding is there, and that is an option as well. But if you imagine, we talked about loans, giving away some shares, family loans, directors loans, all those things are going to show on your balance sheets, which is that statement we mentioned that shows what the company owes and what they're owed, and those things will sit there. Now, with something like Kickstarter funding, where they're advancing you money for the product, you might find they don't touch that at all, because it's not necessarily, if you're delivering a product to them, it's going to go in and out of what they call the profit and loss. But I don't want to get too technical on that right now, because there are so many caveats to that, it's untrue. But it's just trying to get that to feel for a distinction of one is kind of, you sort of, it's almost like trading money, and the other one is something that you're dealing with over here. So they're the main types of funding, so hopefully that helps you out. But for the majority of people, what's going to happen is you're going to go and stick in a director's loan and go from there. Now, I did promise you that I would talk to you a bit about how to actually put it into your books. Now, there's really two things. If you're in the spreadsheet world, you'll just add another column and just mark it as what it is. So if you're in a spreadsheet world, you might want to put, director's loan, you might want to put family loan, or if it's share capital or something, just put it in a separate column. Us as accountants in our practice, we'd much prefer you had more columns than less. One of the worst things ever is when you're analysing a spreadsheet, is you got one column that says miscellaneous and it's got 20 different things. You've got to go and move it all into 20 different columns. So more columns the better, really, from that sense. However, if you're a limited company owner and you've watched any of my other videos, you probably know I stress that I think you should be on cloud software from day one, something like Xero or QuickBooks. And now those, if you've got one of those, generally you're going to point it, when you see it on the bank as the money coming in, you're going to point it to the relevant category. So you're going to either create a new thing for the director's loan if there isn't one, but quite often the default, they call it the chart of accounts, but the default list of categories will have director's loan, share capital, those things, so you can point it to there. If not, a bit like the spreadsheet, create another account for it. If you're going to do a director's loan, it's normally a current liability. If you're going to, not that it shouldn't have a share capital one, but if you are going to do share capital and it doesn't exist, you're normally looking for something called equity. So they're the main ways to enter it into your book. So hopefully this video has been helpful. If you know anybody that would benefit from this info, please do share it with them. And as always, like, subscribe, drop any questions in the comments, and if we can, we will answer them for you. We'll see you on the next one.